The Fed's most watched inflation gauge is getting a total overhaul right before a critical rate decision. Let's start with the story. Shaking Washington. The Federal Reserve's favorite inflation tracker, the Personal Consumption Expenditures Index, is undergoing a major overhaul. The Bureau of Economic Analysis says it's updating how it collects and weights data to better reflect real spending patterns. This matters because the PCE index directly shapes how officials judge whether inflation is truly cooling. The timing couldn't be more sensitive. This overhaul arrives just as a deeply divided Federal Reserve debates whether to raise interest rates again this fall, after more than a year of holding steady. Any changes to how inflation is measured could shift the numbers officials rely on, making an already contentious decision even murkier for markets and consumers alike. Economists warn that revising methodology mid-cycle risks confusing comparisons with historical data, making it harder to tell if inflation is actually rising or falling. Some Fed officials worry this could complicate messaging to the public just as trust in economic data is already fragile. Others argue the update is overdue since spending habits have shifted dramatically since the pandemic. For everyday Americans, the stakes are real. Mortgage rates, credit card interest, and borrowing costs all hinge on what the Fed decides. Markets will be watching closely for any signal on how the revised data might tilt the debate toward a hike or a pause. We'll know more as the Fed's fall meetings approach, but for now, uncertainty is the name of the game. Next up, a major move in the crypto banking world. A fintech startup called Augustus just raised $180 million in a funding round led by Tiger Global, pushing its valuation to a full $1 billion. The company's mission? Build what it calls a global dollar bank that wires stablecoin technology directly into a federally chartered banking license. That's a big deal because it merges crypto rails with traditional regulated banking. Augustus says the goal is modernizing correspondent banking, the decades-old plumbing that moves money across borders through a chain of intermediary banks. That system is notoriously slow and expensive, often taking days and multiple fees for a single international transfer. By using stablecoins under a federally chartered structure, Augustus argues it can settle cross-border payments faster and cheaper. This funding round signals growing investor appetite for infrastructure that bridges crypto and mainstream banking rather than pure speculative trading plays. With a $1 billion valuation, Augustus joins a small but growing club of startups, betting that stablecoins will become core financial plumbing, not just a trading tool. Regulators will be watching closely as this space matures. Meanwhile, over in crypto markets, Bitcoin pulled back from a one-month high this week as crude oil prices topped $85 a barrel, reigniting concerns about inflation. The retreat shows how closely digital assets are now tracking broader macro signals like energy prices and interest rate expectations. Just days earlier, Bitcoin had been climbing on renewed investor optimism. Rising oil prices tend to feed directly into inflation readings, since energy costs ripple through transportation, manufacturing, and consumer goods. That, in turn, raises the odds the Federal Reserve keeps rates higher for longer, which historically pressures risk assets, including cryptocurrencies. Traders are now recalibrating expectations for how central banks might respond in the coming months. This pullback is a reminder that Bitcoin, despite talk of it being digital gold, still reacts to traditional economic pressures like energy shocks and inflation data. Analysts note the asset remains sensitive to macro headlines, even as institutional adoption grows. For now, the crypto market is in a wait-and-see mode alongside broader financial markets. Halfway around the world, a different trend is playing out. In South Korea, crypto trading volumes on the country's 5 major exchanges have shrunk sharply, even as the broader stock market surges. The Kospi index has been on a tear, and it appears retail investors are rotating their money out of digital assets and into equities. This marks a notable shift in a country long known for intense retail crypto enthusiasm. South Korean retail traders have historically been among the most active crypto participants globally, sometimes trading volumes that rival or exceed those in the US. But with domestic stocks rallying and offering more familiar regulatory protections, many everyday investors appear to be chasing gains in equities instead. It's a sign that capital flows can shift quickly when other markets heat up. This trend could ripple beyond Korea's borders, since the country's exchanges are a significant piece of global crypto trading volume. If retail money keeps flowing into stocks, it may dampen crypto liquidity and price momentum in the near term. Analysts will be watching whether this is a temporary rotation or a longer-term shift in investor behavior. Switching gears to trade policy and pharmaceuticals, the Trump administration has announced plans for tariffs on generic drug imports, but with a twist. They won't kick in until 2028, giving companies a 2-year runway to adjust. The stated goal is reshoring low-cost drug manufacturing back to the United States, reducing reliance on foreign suppliers. It's the latest move in a broader push to bring critical supply chains home. The challenge is that generic drug production is dominated by countries like India, which supplies a massive share of the affordable medications Americans rely on every day. Shifting that manufacturing to the U.S. would require major new investment in factories, workers, and regulatory approval, none of which happens overnight. Critics warn the delay may not be enough time to avoid disruptions or price increases. Supporters argue the 2-year delay gives industry a fair chance to build domestic capacity without immediate price shocks to consumers. But skeptics point out that similar reshoring efforts in other industries have taken far longer than expected, and generics operate on razor-thin profit margins that make relocation especially tough. How this plays out could affect drug affordability for millions of Americans down the line. Back to the markets, where stocks and Bitcoin had quite a ride today. Bitcoin held steady near $66,000 even as stocks clawed back from a sharp early decline during today's session. Traders were largely focused on Alphabet's upcoming earnings report, using it as a gauge for the broader health of the AI trade that's been driving much of this year's market gains. Volatility spiked early before markets stabilized into the afternoon. The early sell-off appears to have been tied to renewed anxiety over interest rates and geopolitical tensions, but buyers stepped back in as the day progressed. Bitcoin's relative stability near that $66,000 level suggests some traders are viewing it as a hedge amid the broader uncertainty. Still, the crypto market remains highly reactive to swings in equities and tech sentiment. All eyes now turn to Alphabet and other major tech earnings this week, since any signs of slowing AI investment could ripple through both stock and crypto markets. Investors are trying to figure out whether the AI-driven rally still has room to run, or if we're nearing a plateau. Either way, today's bounce back shows just how quickly sentiment can swing in this market. And finally, geopolitics collided with crypto markets this week too. Bitcoin largely shrugged off fresh jitters tied to escalating tensions between the US and Iran, even as headlines suggested rising geopolitical risk. Both Bitcoin and broader US stocks held relatively firm, defying some analysts' expectations of a bigger flight to safety. This resilience has caught the attention of traders watching how crypto behaves during global crisis moments. Adding to the intrigue, some market analysts are pointing to signs of a potential short squeeze setup building in the S&P 500, where a wave of bearish bets could get forced to unwind if stocks keep climbing. Some observers suggest Bitcoin could see outsized reactions compared to equities if that scenario plays out. It's a reminder that crypto and stock markets are becoming increasingly intertwined. For now, Bitcoin's ability to stay calm amid Middle East tensions marks a shift from past cycles, when geopolitical shocks often triggered sharp crypto sell-offs. Whether that resilience holds if tensions escalate further remains an open question for traders everywhere. We'll continue tracking how these geopolitical and market forces intersect in the weeks ahead. That wraps up today's biggest stories in markets and tech. So here's our question for you. Should the Fed really be changing how it measures inflation right in the middle of a rate decision? Or does that risk undermining trust in the data? Drop your thoughts in the comments below. And if you want twice-weekly deep dives into the stories moving markets, hit subscribe so you never miss an update.